Hello, and welcome to another edition of Wealth Management Insights. I'm Lisa Shalett, Chief Investment Officer for Wealth Management, and today is Monday, June 2nd, and I'm recording this from my office in Purchase, New York. May has been an outstanding month for equity investors, with S&P 500 rising about 6%. Behind these gains have been investors who continue to behave as if the glass is half full, despite continued uncertainty around tariff and tax policy and cautionary signals from other asset classes. Specifically, it seems that equity investors have adopted a singular brand of optimism that echoes the hopes and dreams of Magnificent Seven dominance in AI, as well as confidence that the on-again, off-again policy approach to tariffs is now nothing more than de minimis noise that will ultimately be manageable. We do agree that economic resilience reduces the odds of an imminent recession, and that the S&P 500 should be able to grind out gains of 5 to 10% from here. And there are also potential tailwinds for businesses like the proposed renewal of corporate tax credits and the unusual combination of lower energy prices and a weaker dollar. Still, however, we think this argument falls short of a new bull case, especially given stretched valuations and the disconnect between equities and other asset classes. In particular, the stock market continues to ignore global bond market dynamics where long-term yields are climbing higher. To wit, the 30-year Treasury yield is up about 15 basis points since January 1, while Germany's 30-year government bond yield is up around 40 basis points, and Japan's is up a whopping 70 basis points. So what is this backup in yield telling us? Our take is that this repricing of long-duration risk is part of a new and a broader regime change narrative that reflects the impacts of America's new policy stance. We see at least three fundamental factors at work. First, a significant policy uncertainty remains. Tariff implementation is still likely, and it may now be even more dragged out and sector-specific, potentially involving congressional action. This, combined with the ongoing negotiations on the tax bill, is likely to continue to support Treasury term premiums, which have soared. Second, there are genuine struggles with U.S. debt sustainability posed by the One Big Beautiful Bill. A growing debt pile with higher costs of interest could push the share of tax dollars spent on interest payments even higher. This is now reflected in the level of 10-year real rates, which sit at 2.15%, the highest since 2008. That's before the Great Financial Crisis. Finally, there's the issue of global portfolio dynamics and the convergence of yields. Long rates are rising around the world as the realities of a multipolar power structure demand more monetary and fiscal stimulus from areas like Japan and the European Union. This also comes as Asian investors redirect their foreign currency reserves from U.S. dollar assets to those with higher returns when inflation and hedging ratios are considered. Given these dynamics, investors should consider active stock picking versus relying simply on the passive index. Look to rebalance portfolios and position for average U.S. equity returns of around 5 to 10% against a backdrop of more volatility, higher real rates, and a weak U.S. dollar. Add some diversifying positions to your portfolio in asset classes like international equities, commodities, energy infrastructure, and hedge funds. Lastly, staying overweight in short to neutral duration investment grade and municipal bonds still makes sense to us. As always, thanks for listening, and for more information on portfolio strategies as well as financial planning, please reach out to your Morgan Stanley financial advisor.